Of all assets, cash is the one most susceptible to employee fraud. Due to this, companies develop strict procedures to maintain control of cash. We're going to talk about the definition of cash and cash equivalents. The amount of cash recorded in a company's balance sheet includes currency, coins, and balances in savings and checking accounts, as well as items acceptable for deposit in these accounts, like checks received from customers. In addition, when a company sells products or services to customers who use credit cards and debit cards, the cash to be collected from those sales is nearly always included in the total cash balance immediately. The reason is that cash from those transactions will be deposited electronically into the company's bank account within a few days. The important point to understand is that all forms of cash and cash equivalents are usually combined and reported as a single asset in the balance sheet of most companies. This line item is usually referred to as cash or cash and cash equivalents. So what do you think here? Which of the following would not be considered a cash equivalent? We've got credit card sales for the day, debit card sales for the day, money orders received from customers, or certificate of deposit, a CD that matures 1 year from now. What do you think there? Hopefully you chose the CD. That has is an investment, or would definitely be linked on the books as something that is not currently available. Cash includes currency, coins, savings accounts, checking accounts, credit card sales, debit card sales. Cash equivalents are defined as investments that would generally mature within 3 months from the date of purchase. Since the CD doesn't mature until a year from now, it would not be considered a cash equivalent. Let's talk about controls over cash receipts and cash disbursements. Internal controls over cash receipts should include the following: making a list of checks received, including the amount and payer's name every day. Have the designated employee deposit checks into the bank every day. This person should be different from the person who receives cash and checks. Have another employee record cash receipts in the accounting records as soon as possible. Have cash receipts verified by comparing the bank deposit slip with the accounting records, and then accept credit cards or debit cards to limit the amount of cash that's handled. So in a perfect world, having different employees handle each of those functions is really wise. Now, the problem with sometimes being able to have someone do that is when you're dealing with smaller companies, sometimes you just don't have the manpower to allow for those separation of duties. Now, internal controls over cash disbursements should include making all disbursements by check, debit card, or credit card to provide a record for the transaction, verifying the accuracy of the purchase, and authorize all expenditures before purchase. The employee authorizing payment should be different from the person preparing the check. Make sure checks are serially numbered. Requiring 2 signatures for larger checks is always a great idea. Check amounts shown in the debit card and credit card statements against the purchase receipts, and set maximum purchase limits and give approval to purchase above these amounts only to upper level employees. Again, safeguarding assets, having guidelines of protecting those assets is a great idea. Controls. Now, As far as the ability to reconcile a bank account, we're going to spend a good bit of time in this chapter, and we're going to have several examples that really help walk you through reconciling a bank account. A company's cash balance is recorded in its books. It rarely equals the cash balance reported in the bank statement. Another important control used by all companies to help maintain control of cash is a bank reconciliation. Now, the bank reconciliation matches the balance of cash in the bank account with the balance of cash in the company's own records. Differences between the two are usually due to timing differences, or there can be errors. Timing differences in cash occur when the company records transactions either before or after the bank records the same transaction. Errors can be made by either party, either by the bank or by the company. So this slide provides you with an example of a bank statement. First Bank's ending balance of cash of $4,100 differs from Starlight's ending balance of cash of $2,880, which you'll see over down here. To understand why these two balances differ, we need to talk about the timing differences and to also see if there could be any errors. Now, this slide shows the company's records. On the bottom, you see that the company's ending cash balance, again, here is $2,880. This is different from the bank balance of $4,100 shown on that bank statement right here. We need to compare the details of both the deposits and the checks to figure out what's going on here. Now, first, we're going to consider cash transactions recorded by the company, but yet not recorded by its bank. These would include deposits outstanding and checks outstanding. Deposits outstanding are cash receipts of the company that have been added to the bank's record of the company's balance. Checks outstanding are checks the company has written that have not been subtracted from the bank's record of the company's balance. This slide shows how the line item comparison would be made, first on the company's cash receipts and then on the company's checks. The items that cannot be located on the bank statement are reconciling items. They need to be placed on the bank reconciliation. The first comparison has resulted in a deposit outstanding. The second comparison has resulted in 2 checks outstanding. So you see here, one of the deposits has not hit the bank, and 2 of the checks have not hit the bank. We can now prepare the bank side of the reconciliation. Notice that the left side begins with the bank reconciliation. The left side begins with the bank reconciliation, and we have the bank balance of $4,100. This amount differs from the balance of cash in the company's records of $2,880. We adjust the bank's cash balance by adding deposits outstanding and subtracting checks outstanding. We'll also need to look for and correct any bank errors, but so far we don't see any yet. Next, we need to reconcile the company's cash balance for items which have been recorded by the bank but yet not recorded by the company. Common items that will increase the company's cash balance include collections made by the bank on the company's behalf and interest earned on the average daily balance. Common items that will decrease the company's cash balance include NSF checks, non-sufficient funds, which are customers' checks written on non-sufficient funds, and the company needs to decrease its cash balance to undo the initial increase. Also, debit card purchases that are immediately withdrawn from the bank account, electronic funds transfers, also known as EFTs, which are automatic transfers from one bank account to another. Oftentimes, they pay a mortgage, a utility bill, or a similar type of expense. And then bank service fees for monthly maintenance, overdraft penalties, ATM use, and other services. So an itemized listing of the types of transactions that occurred with Starlight are shown right here. So here we've got which items here, in the bank statement are not yet reflected in the company's cash records. Any deposits or credits by the bank add to the company's cash balance. Any withdrawals or debts by the bank subtract from the company's cash balance. Also, the bank statement can reveal any recording errors by the company. Now, in this case, the company has check 294 that was written for $2,900 for rent expense, but the company recorded the payment in its own records for only $2,600. This means the company needs to subtract an additional $300 to correct this error. To complete the bank reconciliation, we need to consider the items in the bank statement that are not yet recorded in the company's cash balance. 6 cash transactions recorded by First Bank are not reported in Starlight's cash records by the end of March. Number 1, the note received by First Bank on Starlight's behalf, $3,000, which equals $2,800 plus related interest received of $200. Then, next we have interest earned by Starlight on its bank account. Next we have an NSF check of $750. Then we have a debit card purchase of office equipment by an employee for $200. Then we have electronic fund transfer, EFT, related to the payment of advertising for $400. Next, we have a service fee of $50. There is also a check error that we talked about, the $300 for the check that we input incorrectly, that we need to subtract an additional $300. The company adjusts its balance for information that was revealed in the bank statement. So for this reconciliation to be complete, the reconciled bank balance must equal the reconciled company balance. Now, as you see here, with adding these various items, we do then get the bank balance and the company balance to equal. This slide presents basic items that are included in a bank reconciliation. So as you see here, we start with the bank's cash balance, then we add any outstanding deposits, subtract any checks outstanding, plus or minus any bank errors. Over on the other side, we take the company's cash balance, we add any notes received by the bank and interest, minus any bad checks, or possibly any unrecorded debits or EFTs or bank service fees. Again, we would add or subtract any company errors, and ultimately after we do that, we should balance. So guys, what do you think here? Which of the following items would be found on the bank side or the left side of the bank reconciliation? Would we look for interest income received on the account, deposits outstanding, NSF check from a customer, or service fee charged by the bank. So which of these items would be found on the bank side of the bank reconciliation? So basically, the interest income that was received by the bank will show up in the bank statement. Any NSFs will also show up. Service fees are going to show up. But those items that we will need to add on the bank reconciliation would be any deposits that have not yet cleared the bank. So basically what's happening here is we know a deposit was input in the company's records, but it has not yet cleared the bank account. What about this one? How would an NSF check from a customer be treated on a bank reconciliation? A, addition on the bank side, deduction on the bank side, addition on the company side, or a deduction on the company side. I want you to think about this now. The NSF we find out about because the insufficient funds that gets returned, what we deposited doesn't hit when they go and try to clear it through the customer's bank account, it gets rejected. There aren't enough funds. It comes back to us. What is it we do to correct and create our balance? We're going to deduct it on the company side. Think about it. When we receive income from a customer, we add it to our cash. When we've received an NSF, which means insufficient funds, we then need to subtract it. We don't have that money. We need to subtract that NSF from that deposit. An NSF check would be shown on the company side, the right-hand side, and it would be shown as a deduction. This is because when the company originally deposited the customer's check, they increased the cash account. Now that the check has been discovered to be an NSF check or insufficient funds, the company must reverse the cash out of its books, resulting in a decrease or a deduction on the company side of the bank reconciliation. Now, a common mistake that can happen, individuals make a mistake that an NSF check as a bad check written by the company instead of one written to the company. When an NSF check occurs, what that means is the company's deposited a customer's check, but the customer didn't have enough funds to cover it. The company has to then adjust the balance of the cash account downward to reverse that increase in cash it thought it had. It recorded at the time of the deposit. As a final step in the reconciliation process, a company must update the balance in its cash account to adjust for the items used to reconcile the company's cash balance. Some people try to update the cash account for deposits outstanding, checks outstanding, or a bank error. The company doesn't need to adjust for these items related to reconciling the bank's balance because they have already properly recorded those items in the company's accounting records. These adjustments are recorded once the bank reconciliation is complete. Remember, these are amounts the company didn't know until it received the bank statement. So the company is going to need to show the notes receivable and various interest receivable and interest revenue. Also, items that decrease cash, any items of purchases or service fees or debits for equipment, advertising, rent, NSF fees, these will have to be decreased. The accounts receivable is clearly an item that is getting decreased because we thought we had the money, and when we deposited a customer's check and it was returned. Here's a question for you. How would an NSF check from a customer be recorded in the accounting records? Would we debit accounts receivable and credit cash? Debit cash, credit accounts receivable, debit accounts payable, credit cash, or debit cash, credit miscellaneous expense? I want you to think on this for a minute. We had the deposit, we cleared it up, but here, lo and behold, the NSF check comes back through the bank statement that shows what we thought was a deposit now isn't good anymore. What will we do? Accounts receivable is what's going to get debited in order to accrete that asset. It shows that the customer who paid with an NSF still now owes the company money. The cash account is credited because the company must adjust its balance of cash downward to reverse the increase in cash it recorded at the time it received the check from the customer. Remember, some students try to update the cash account for deposits outstanding, checks outstanding, or a bank error. Nope. The company doesn't need to adjust it because the company's records are already okay. Those items get adjusted when you reconcile the bank balance. Let's look at exercise 4.9 to go through a bank reconciliation. So Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st, 2018. The July cash receipts of $1,885 included in the general ledger balance are placed in the night depository at the bank on July 31st, and they get processed by the bank on August 1st. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. The bank statement shows a balance of $22,490 on July 31st. We need to prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st, 2018, and then we're going to record any adjusting entries to correct our cash balance. So we have our book balance of $22,970. We have our bank balance of $22,490. That's the first thing we're going to do, is first start with the correct balances, one for book, one for bank. Then we need to look at what are items that have hit the company's books but have not affected the bank statement, the bank balance? Well, we know there was the $1,885 deposit that happened that night and didn't get processed until the next month. So the bank's balance does not reflect that deposit, but yet our company's balance does reflect that deposit. So we have to add that to the bank's reconciliation. There were checks totaling $1,460 that did not hit the bank statement. Therefore, we need to appropriately add those checks to the bank reconciliation to reflect what is evident in the company's balance. So if we take the bank's balance, add the outstanding deposits, subtract the outstanding checks, we come up with a bank balance reconciliation of $22,915. Now, the way we reconcile the company's books is we look to see if there's anything that transpired through the bank statement we do not show on the company's records. There was one item, a service fee of $55. That service fee was deducted from our bank account. Therefore, we need to reconcile the company's books by taking that service fee and subtracting it from the company's balance. Once we do that, we can see that the bank balance for reconciliation versus the company's balance per reconciliation now equal. Now, the next thing we have to do is prepare the journal entry to adjust any items that need to be added to the company's records. Remember, we don't have to do anything with the bank, the items that have not entered through the bank yet, because those are already in the company's records. These are items that happened with the bank that we need to reconcile for company purposes. The service fee is the only item, so we will debit. We always debit an expense, so we'll debit our service fee expense and we will credit our cash for $55. Let's look at another problem. This is another bank reconciliation, maybe a little more involved than this last one. On exercise 411, it tells us that October 31st, Damon Company's general ledger shows a checking account balance of $8,397. The company's cash receipts for the month total $74,320, of which $71,295 have been deposited in the bank. So we know that there is still a deposit or a certain amount that has not gone through the bank. In addition, the company has written checks for $72,467, of which $70,982 have cleared the bank. The bank statement reveals an ending balance of $11,727 and includes the following items that have not yet been recorded by Damon Company. Bank service fees of $150, a note receivable collected by the bank of $5,000, interest earned on the account balance, plus on the note of $320. And then after looking closer, Damon realizes that the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. The bank agrees they made a mistake. So, what are the processes in reconciling this account? As you see here, we're going to start by starting with the bank's balance and the company's balance. So we have the bank balance was given to us of $11,727. The company's balance was given to us of $8,397. If we take the difference between the cash receipts minus what has gone through the bank, we know that $3,025 are still deposits outstanding that have gone through the company but have not cleared the bank account. So we're going to add those to the bank reconciliation so we match. They also tell us that the company wrote $72,467 worth of checks and $70,982 have been cleared by the bank. What that tells us is that $1,485 of checks are still outstanding, have not cleared the bank. So if we take the bank's balance, we add the outstanding deposits, we subtract the outstanding checks, and then we know they made an error of $300 that the bank needs to reimburse us for. Those three items will give us a bank balance based on our reconciliation. Now the company has items that as we look at the bank statement, we have not recorded. The note of $5,000 has been received. We didn't know about that until we saw the bank statement. So we need to adjust our company balance by that amount, $5,000. We also earned $320 of interest from our account and from that note. We need to adjust. And we had service fees of $150 that the bank statement provided us with. We need to adjust for. Remember, the bank error of $300 does not affect our company records at all because we had it right. The bank messed up. The goal in showing this reconciliation is to make our bank's balance equal our company's book balance. Once we correct these items, then in fact they will equal. The $13,567 needs to be our new cash balance. Now they ask us to prepare the journal entries to correct any items that we have uncovered. The cash needs to increase as a result of the notes receivable and the interest revenue. Now remember, our cash goes up because it did hit our bank. The note that we had at one time needed to receive from a customer has in fact come in. So we credit that asset because we no longer, they've paid us in full. We no longer are expecting anything. The interest revenue is a revenue item. We earned interest on our account and from the note. So this journal entry records the note and interest collected by the bank. The next journal entry handles the service fee that the bank charged us. Expenses always are debited to increase. So we have a service fee expense of $150 and we credit cash of $150 to record our bank service fee. Now we're going to talk about employee purchases and using a petty cash system. Cash on hand to pay for minor purchases is called a petty cash fund, and the employee responsible for the fund is often referred to as the petty cash custodian. Accounting for the petty cash fund involves recording transactions to establish the fund, to recognize expenditures from the fund, and then to replenish the fund as the cash balance becomes low. So in this example, management establishes a petty cash fund by writing a check for cash against the company's checking account and putting the amount of withdrawn cash in the hands of an employee who then becomes responsible for it, the petty cash custodian. A journal entry is made debiting petty cash and crediting cash. So if you think about it, petty cash is just another type of cash equivalent. Now we're going to look at some examples here. Assume Starlake had these during May. During May, the petty cash custodian provides cash to employees for the office lunch and package delivery and places vouchers documenting the purposes of these expenditures in the petty cash fund. In addition, the purchasing manager and the marketing manager use their credit cards for expenditures related to their positions. At the end of May, the company's accountant collects the vouchers from the petty cash fund and credit card receipts from the managers and records the transactions in the company's records. These expenditures made with the petty cash reduce the amount of cash that's in the petty cash. The expenditures made with credit cards are not paid immediately, so they are recorded as a credit to accounts payable. So as you see, the lunch and delivery is taken out of petty cash, and the credit cards are shown here as an accounts payable. The fund has only $50 left in it, so management withdraws an additional $150 from the bank to replenish the funds. The fund's physical balance will again be $200. What if only $30 physically remains in the petty cash fund at the end of May, when there should be $50? It could be that $20 was stolen from the fund, or the fund could be missing a receipt for $20 to show where it was spent. If the question's not resolved, the firm will likely charge the $20 to a miscellaneous expense. Here we're going to begin talking about how companies report cash activities to external parties. We're going to talk about the major cash inflows and outflows of a company. Companies report cash in two financial statements, in the balance sheet and in the statement of cash flows. Now, the balance sheet, as we talked about in a previous chapter, is where companies report cash as an asset in the balance sheet. The amount's typically reported as a current asset and represents cash available for spending at the end of the reporting period. The balance sheet provides only the final balance for cash. It doesn't provide any details regarding cash receipts and cash payments during the period. Remember, we talked about how a balance sheet is just a snapshot on a period of time. However, the statement of cash flows is where the company reports information about cash receipts and cash payments during the period. This is through the financial statement called the statement of cash flows. There are three fundamental types of business activities relating to cash. We've talked about this briefly. We're going to talk about it again. Operating activities, investing activities, and financing activities. Now, operating activities include cash transactions involving revenue and expense events during the period. In other words, operating activities include the cash effect of the same activities that are reported in the income statement to help us calculate net income. Investing activities, as the name shows, include cash investments in long-term assets and in investment securities. When the company later sells those assets, we consider those transactions also investing activities. So investing activities, generally speaking, are going to be long-term assets. Then we have financing activities. These include transactions designed to raise cash or to finance the business. There are two ways to do this. One is to borrow money from lenders, or we raise cash from shareholders. We also consider cash outflows to repay debt and cash dividends to stockholders to also be financing activities. So financing activities involve both liabilities and they involve stockholders' equity. Now let's go back and look at some transactions for our good old Eagle Golf Academy. This slide shows those transactions and it analyzes the effects on the company's cash. Which transactions involve the exchange of cash? What do you think here? Well, pretty much all of them do except number 5 and number 7. Only transactions involving cash affect a company's statement of cash flows. So you see selling shares of common stock affect cash, borrowing from a bank, purchasing equipment, paying for rent, purchasing supplies on account, cash wasn't involved there. Provide golf training to customers for cash? Yes. Number 7's providing golf training to customers on account. Cash wasn't affected there either. Receive cash in advance for 12 golf training sessions, pay salaries to employees, and to pay cash dividends. So out of these 10 transactions, only 2 did not directly affect our cash. You see next to each of these transactions, it clearly shows what type of activity the transaction relates to. Really, really important for you that you take some time and go through these various transactions so you can feel fairly confident that you're understanding what type of transactions go into which type of activity. Remember, items related to the normal course of operation, receiving revenues from services and paying out expenses, would be operating. Financing is finding ways of receiving money to finance the company. And then investing is purchasing long-term assets. This slide presents the statement of cash flows for Eagle Gold Academy using the direct method, Eagle Golf Academy using the direct method of reporting operating activities. The corresponding transaction numbers are in brackets. Down the road in this course, we'll discuss this statement in a lot more detail and provide some other ways of which we can create a statement of cash flows. So as you see, the operating activities are listed in here, 6 and 8, 9 and 4 for operating, which an overall minus $3,900 from operating activities. From investing activities, we have a minus $24,000, and financing activities ended up with a positive $34,800, with an overall increase in cash for the period of $6,900. Let's check your understanding. Which of the following items would be categorized as an investing activity on a statement of cash flows? Borrowed money from a local bank by signing a note to repay the full amount 2 years later? B, paid for supplies in cash? C, paid for the purchase of equipment using cash? D, paid salaries to employees. What do you think there? I want you to spend a couple minutes trying to see if you can understand the various activities. Equipment, long-term assets, are a form of investing activities. Cash flows from investing include the purchase or sale of long-term assets. The purchase of equipment using cash would be shown in the investing activities section as a decrease. Borrowing money would be financing activities, and purchasing supplies and payment of salaries would be the operating activity section. Cash analysis will be our next section to discuss here. And we're going to talk specifically of how we assess cash holdings by comparing cash to non-cash assets. Now, in recent years, cash holdings of U.S. companies have increased significantly. At the end of 2014, total cash holdings of U.S. companies, apart from banks and financial institutions, were estimated to be $1.7 trillion. Total cash holdings were less than half that amount just 7 years earlier. One reason for larger cash holdings is to ensure cash is available to prevent bankruptcy caused by short-term negative shocks in the business cycle. The financial crisis back in 2008 caused a lot of companies to go into bankruptcy, and many others struggled to meet their financial obligations. As a result, companies started keeping larger reserves as a precaution so they don't get put in that situation again. On the other hand, sometimes having too much cash represents idle resources that aren't being used productively to produce revenues, or that may be spent inefficiently. So just because a company has a lot of cash isn't necessarily a good thing. A company with too much cash may be a signal that management does not have additional opportunities for any profitable expansion. This slide shows each company's ratio of cash and cash equivalents to non-cash assets at the end of 2014. Non-cash assets include total assets other than cash and cash equivalents. Why is Cinemark's ratio of cash 3 times greater than Regal's? One reason is that management of Cinemark may be more cautious due to more volatile operations. This could be seen by looking at the company's trend in operating cash flows. While the total amount of cash generated from operating activities over the 3-year period is slightly greater for Cinemark, we can also see that Cinemark's operations are a little more volatility. And volatility has risk attached with it. Let's look at another question for you. Which of the following statements is true? A, having too much cash represents idle resources that are not being used to produce revenues. B, one way to assess cash holdings is to compare cash assets to non-cash assets. C, in recent years, cash holdings have increased tremendously. or D, all the above? You got it there. All these statements are true. Let's take a look at our final problem, problem 4-5B. We've got various items we're going to cover in this problem. So we're going to start with preparing a statement of cash flows for the month of August, properly classifying each of the transactions into operating, investing, and financing activities. The cash balance at the beginning of August is $8,300. So Peter loves dogs and cats. For the past several years, he's owned and operated Homeward Bound, which temporarily houses pets while their owners go on vacation. For the month of June, the company has the following transactions. We're going to take the next 3 slides and record each of these transactions. June 2nd, obtain cash by borrowing $19,000 from the bank by signing a note. You see the first transaction, June 2nd, we debited cash for $19,000. We credited notes payable for $19,000, and our memo is borrow from the bank. On June 3rd, we paid rent for the current month, $1,200. We posted that transaction or recorded it by a debit to rent expense and a credit to cash for $1,200. On June 7th, we provide services to customers, $5,200 in cash and $3,500 on account. So you see here, June 7th, debit cash of $5,200, debit accounts receivable for $3,500, and we credit service revenue, $8,700. June 11th, we purchase cages and equipment necessary to maintain the animals for $8,400 cash. We show a debit to equipment, $8,400, and a credit to cash. June 17th, pay employee salaries for the first half of the month, $6,500. Debit salaries expense, credit cash. June 22nd, pay dividends to stockholders, $1,550. We debit our dividends for $1,550, and we credit cash for $1,550. June 25th, we receive cash in advance from a customer who wants to house his 2 dogs and cat while he goes on vacation for the month of July, $2,100. So you see here, cash is debited for $2,100, and we have a liability account, deferred revenues, for $2,100. June 28th, pay utilities for the month of $3,300. We have a utilities expense, $3,300. Cash is credited, $3,300. June 30th, record salaries earned by employees for the second half of the month, $6,500. Payment will be made on June 2nd. Well, the payment's going to be made on June 2nd, but we need to record it in this period. So we debit our salaries expense of $6,500, and we credit salaries payable for $6,500. Now the second requirement is identify the transactions involving cash. All those transactions involved cash apart from the last transaction when we recorded the salaries expense and the salaries payable. Next, prepare a statement of cash flows for the month of June, properly classifying each of the cash transactions into operating, investing, and financing activities. So as you see here, we have taken them and started with our operating activities, showing the cash inflows and cash outflows. Then the investing activities only include purchasing the equipment, and the financing activities involve borrowing from the bank and paying out dividends. So we will take each of these categories and subtotal them so we can see our net cash flows from operating activities is a minus $3,700. Our cash flows from investing activities is a minus $8,400. And our net cash flows from financing activities is a plus $17,450. Our net increase in cash throughout the period is $5,350. We were given our cash at the beginning of the month of $14,700. So we have cash at the end of the month of $20,050. I missed a section here where it says in number 3, assuming the balance of cash at the beginning of June is $14,700, post each cash transaction to the cash T account and compute the ending cash balance. So if we take each of those cash transactions here, which are basically all of them except the last one, on June 2nd we debit $19,000 to cash. June 3rd, credit $1,200. June 7th, debit $5,200. June 11th, credit $8,400. June 17th, credit $6,500. June 22nd, credit $1,550. June 25th, debit $2,100. June 28th, credit $3,300. If we do that, we show our debits and we show our credits. Our balance in cash is $20,050. That is the same ending balance we received in our statement of cash flows of $20,050. The final requirement is verify that the net cash flows reported in the statement of cash flows equals the change in the cash balance for the month. So our statement of cash flows shows $5,350, as you can see right here. Our change in balance for the month, we ended it with $20,050. We began it with $14,700, and we'll be able to see that $14,700. We ended it with $20,050. Statement of cash flows shows us the same here. So ultimately, our changes in cash flows during the period is the $5,350. That does it for Chapter 4. Take your time, review it as often as you need to understand this chapter. Take care. So the first thing we're going to do is record these transactions. So June 2nd, it says obtain cash by borrowing $19,000 from the bank by signing a note. So our transaction on June 2nd would be a debit to cash for $19,000, a credit to notes payable for $19,000. Let's go back to the previous slide. On June 3rd, we pay rent for the current month of $1,200. As you see, June 3rd, a rent expense, debit $1,200, cash is a credit for $1,200. We're paying the current month's rent. Next, June 7th, provide services to customers, $5,200 for cash and $3,500 on account. June 7th, we have cash of $5,200, accounts receivable of $3,500, and we credited our service revenue of $8,700. Next, June 11th, purchase cages and equipment necessary to maintain the animals of $8,400 cash. Did I not put that in?